Hello, Digital King subscribers. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners here in the Dividend Kings marketplace service on Seeking Alpha. Today, I'm going to cover one of the most befuddling stocks I think that I've ever covered, Meredith Corporation. In a few moments, I'll talk about why I find the stock befuddling, but before I do, I want to go ahead and talk a little bit about who the company is and what they do and what some of their products are, because a lot of people don't really know the business. So let's start by taking a look at some of their brands. In the printed brands, you see they have some of the most popular magazines on the planet. You know, the company right now reaches out to 90% of all the women in the United States, and they have tremendous advertising opportunities. And even in the crisis we're in right now, not only do they have these printed brands, but the company also has significant digital brands with some of the very same entities, you know, parents, wedding, etc. So even though people aren't going to be leaving their homes, they're still going to be utilizing and have access to Meredith and their brands. The company also has significant licenses and TV stations and so on. So it's really quite a remarkable digital and printed media company. With that said, what I really find befuddling about this company is the way the market has been pricing it. In 2017, they purchased Time, the brand of Time, which included, of course, Time magazine, but also included Sports Illustrated, which they sold. I get the feeling that Sports Illustrated didn't really match their, focus on marketing to millennials and marketing to the leading percentage of women in the country. In other words, Sports Illustrated probably didn't fit them, so they got rid of it. But what happened there was that as the company was transitioning from print, which is where they generated this track record, I believe it's a 118-year-old company, 73 consecutive years of paying dividends, 23 consecutive years of increasing the dividend. The bottom line is when they announced this purchase in 2017, they did point out initially that their EBITDA was going to be significantly higher than it's ever been, and that forecast is still there. And I am going to shorten the forecast here because you'll notice there's no one forecasting a dividend. I'm going to stick to this year, which ends in June, and next year's forecast on this company, because when I go ahead and look at forecasting data, you'll see that we only get one analyst going up beyond 2021. So I'm kind of sticking with the current forecast. Now, originally, these numbers were actually slightly higher than they currently are now. And maybe perhaps that's what caused some of the problem. Another area of weakness I see with the company is when you look at diluted earnings, they had two issues. We had the changes in the tax laws caused their diluted earnings to drop precipitously for fiscal year 2016, which ended in June of 2016. And then in 2019, after the disposition of the Time and the purchase of spending $2.5 billion on the Time properties, they did have a significant drop. Preferred dividends went up dramatically, but these were one-time charges. When you look at the company from a standpoint of operating earnings, the company's growth has been spectacular and is expected to be significantly higher. So let me just bottom line it and not get too detailed here. The thing that befuddles me is I see the company's future earnings and cash flows rising dramatically. And operating cash flows are doing as well or better than they've ever done. And, in the company itself, if you go into their slide presentations, you can see that they're forecasting tremendous growth in operating cash flow, which tells me that the dividend is very well protected on an operating cash flow basis. But also, if I look at the company from a free cash flow point of view, the dividend is also very well protected. Now, once again, they did get, after the acquisition, which closed in 2018, the Time acquisition, their free cash flow temporarily dipped, but you can see it rose dramatically for the fiscal year ending 2019. It's expected to rise again this year and next year. So I see the dividend being extremely well covered. The company is very covetous and proud of their long-term dividend record, and they have the cash flows to continue to pay that dividend and keep that 73-year streak of paying one, and that perhaps even that 23-year streak of increasing their dividend every year going up as well. So, but yet, with all that said, the price is significantly being just decimated here by the market. Now, I don't get it. I don't understand it. The company's dividend yield is currently over 18%. Let me go back to earnings here because I like to talk about earnings yield. Although EBITDA yield and all these yields are relevant, I do want to talk about earnings yield. The company has almost a 50% earnings yield. The dividend yield is 18.29. You can buy the stock at a blended PE of 2, basically. It's a B-plus rated company with 65% long-term debt to capital. But one thing, without boring you with it, virtually all the company's debt is long-term debt, and management is committed with their allocating a lot of their cash flows to getting rid of this debt or to lowering the debt. And they've already done a pretty good job of that here because they took on a lot of debt when they made the Time acquisition. Nevertheless, the bottom line here is I don't think I've ever seen such a discrepancy where I've seen earnings rising so much, I've seen cash flows rising so much, and yet the market is just literally killing the stock. And this was actually going on even prior to the virus epidemic that we're currently facing now, because this really started in June of 2019. We've had this steady drop. Then, of course, the recent crisis has exacerbated it more. Now, kind of interestingly, if you look at the company today, it's kind of holding up pretty well relative to a lot of stocks. It's down another 5%, but it's down 67 cents. But again, the overall market is off. But a couple of things I want to point out. I want to take a look at forecasting here. So let me go back to the graph and let me go back to adjusted operating earnings, because I do want to show you that it's not just the analysts reporting to FactSet that are forecasting these numbers. And FactSet has 5 analysts, and we're looking at $6.19 of earnings for this fiscal year, which is going to be down slightly from over last year. And that's part of that is because of all this transition stuff I've talked about. But we're looking at, a earnings of $6.19 and $6.70 next year. If I go to Yahoo, Yahoo's looking for $6.47 for this fiscal year, or above our $6.19, and $6.62 for next year. So we have slightly less expectation off of the Yahoo analysts, which I believe they get their data from Reuters, and we have significantly more earnings estimate on Yahoo than what we have on FastGraphs right now from FastFacts. Now, checking another source, if I go to Seeking Alpha, who gets their data from Standard & Poor's, we're looking at earnings of $6.21, which is a couple of pennies higher than what we got on FastGraphs, and then $6.53. And here we only have 4 analysts. Bottom line is we really do have a consensus here of earnings estimates being significantly higher than they've historically been, number one. But not only that, significantly higher, over the average that we've seen over the many years. I'm kind of got myself lost there in my own conversation. But the point is, I just can't understand why this stock is so cheap. They just made an announcement here recently that the company has signed a significant extension of their deal with CVS, going out actually several years. And they extended this deal in 7 major markets, and they include 3 top 25 markets: Atlanta, Phoenix, and St. Louis. So, I just don't see anything really that wrong with this company, and yet I see the stock price down here in one of the most incredible sell-offs that I think I've ever seen in my career. As long as I continue to see the fundamentals here, I'm going to argue that this is a great investment. I already have a large position in it. I'm underwater in the position. I don't mind disclosing that. However, I do believe, and I'm kind of being a little patient here, but I do believe that I will be adding dramatically to the Meredith position. I'm kind of waiting to see if anything material is going to happen here, but all the news I see is good. Insiders are buying the stock. Other portfolio managers are buying the stock. There's just an awful lot to like here, and yet the market's treating the stock like it's a piranha. So I would encourage you to do your own due diligence and make your own decisions. But the moral of the story is, when fundamentals are this good and the price is this low, this is either an opportunity or we're really missing something dramatic. And I've been looking hard, and all I can continue to see are bright skies for this company. And this has been Chuck Carnevale saying thanks for watching. If you like these kind of ideas, and don't forget to subscribe to our YouTube channel, because I'll be putting out a lot of videos on YouTube in addition to what you see here on Dividend Kings or other services that I publish on. Thanks for watching.